Hello, hello. We'll get everybody in here real quick. Let everybody come on in. Happy Thursday. Everybody say hi in the chat. Happy Thursday. Happy Thursday. Anything exciting going on today? Any wins, any losses? Anybody want to say anything just in your mind? Hello, everyone. Hello, everyone. Awesome. Yeah, we'll let everybody come in here. It's perfect. We have a few minutes here. So, wait, hold on. Roger, did you say you're getting money from Nigeria? Yeah, I bet you are. I bet you are. Aren't we all? I mean, let's just send it off. I mean, when they send you and they call you, just, freely ye give. Yes, and so actually this will be a great run through today because this is live, real good stuff. So one of our mentees in a small little group, they've been making offers on different deals, and they have one in particular in Phoenix that's a 16 unit that they've gone through the process of, they found it, they've underwritten it, they've submitted a letter of intent, an offer to purchase it, and they've gone back and forth, and now they're into the next round, which is called the best and final, where the broker got back to them and there's maybe a couple other offers on the table. So now they're in the best and final process. So that way the seller can select the best offer. And so they're trying to decide at this point, oh my gosh, what do we do? And how do we handle it? And what do we do this? So that we're going to handle that today. So that way you can kind of literally see the process that you may end up going through at any point in time when you're making offers on these commercial properties in these multifamilies, whether it's a 5-unit, 10-unit, 15, 20, 50, 100 plus, you're going through similar processes. And you have to realize and look at it like this. This is very important. If you're the only offer on the property, not to say that it's not a good deal, but if you're the only offer on the property, you may want to ask yourself some questions, because think about that for a minute. I mean, if you're the only person that has interest in that property, it may not be the best deal. Not to say it can't be, because maybe it's on market a long time, or they have it way overpriced, and then you've been able to kind of come in and negotiate it down. But if it's newer on the market and you were the only person interested in it that has an offer in on it, probably not a good deal, or something's going on, because that smells. Because think of it in the sense of, if other people like it too, then it's probably a pretty good little property. And so the competition's a good thing. And just stick to your guns, because you may have to make a lot of these in order to get one that's actually going to make sense and you lock and load. So this process is very important, but this is how you do it. So today's a great kind of true case study live in real time. And I'm going to try and bring Kiana up if she's available to walk through the scenario and what's going on. And then I'm going to throw their numbers up on the screen if they're okay with it, show you the property, show you their numbers, show you the letter of intent they submitted, and the exact process that they've gone through from finding it, analyzing it, submitting an offer, and where they're at today, where they could go into the escrow process, which is this. Where did I go? Oh, my pen. Right. So they've gone through, they found it, they've analyzed it, and now they're literally getting ready to enter this process. So step one, they found it, then they've analyzed it, and they're literally right here. Right? We're ready to go. We're going to make it happen. We're going to execute and get into the escrow process, where we're handling capital and loans and all that stuff. So this is where they're at in that process. So it's really important. We'll go ahead and focus on it right here today. So awesome. Yeah, Kiana, I'm going to try and bring you up. I'll do it right now and see what happens here. I don't know if you want to show your face.
Either way works. No worries. Can you hear me?
Yes, I can hear you. Can everybody else hear Kiana? Put a little thumbs up. Okay, great. And then what I'm going to do, Kiana, is I'm going to share my screen that shows the property so everybody can just see what we're going to talk about specifically.
Awesome.
And that way there's reference for everyone. Cool. Great. So everybody can see the property up on the screen. This is a little 16-unit deal in Phoenix, Arizona that they've offered on. So maybe give us a little backstory, Kiana, and starting from the initial offer to where you're at today.
The initial offer, so we found this property from an off market. Shane actually built a relationship with the broker, and then Cass actually had time to meet him and tour properties. We've maintained it. And then I happened to be in Arizona as well. So we were able to tour this property. It was built in 2004. So we went through it. Then Shane ran the numbers for us. It looks like a really good deal. So then we submitted our first letter of intent last week. It didn't seem like we were going to get it based off the conversation with the broker, but then he reached out to us on Monday and said that we're going to be in the best and final offer stage. And so we get to see, or he had us also, we asked for feedback on our initial letter of intent from him because our escrow payment was at 1%. And so he asked us to increase our escrow payment to be a little more competitive. And if we had any room to increase in the price as well. So we increased it by like $500,000.
Okay.
And we changed our escrow deposit from 29,000 to 50,000. And so I think that's what got us to the best and final, and that's where we're at now.
Right now, if I'm not mistaken, you're at $3 million. Is that what I'm gathering?
Correct.
And that's your best, is that where you're going in at your best and final, or you don't know yet?
We don't know yet. So that's what we're trying to figure out. We think this is our actual best and final, so we don't know if we have more wiggle room.
Sure. Yeah, great point. So, and I'll show you guys the numbers here in a minute, because this is kind of where you stick to your guns. So understanding when the property was purchased. So the existing owners purchased it in May of 2021. Is that accurate?
Correct.
Okay. So what that tells me, based upon the timing of the markets, is they purchased this in the peak of the multifamily commercial real estate market in 2021, which was the peak of the market. We actually purchased a deal in October of that year, and that was the true peak. Because that all these properties that have been purchased in 2021 and even 2022 were probably purchased with variable rate debt. Does this one have fixed rate debt on it?
No, it's assumable loan. Is it fixed rate? Oh, I think it is fixed rate now. Yeah, it's 6.63. Yep.
Yeah, but interest only for a couple more years, I'm guessing.
Yes, until 2028.
Okay, which is nice.
But field maintenance, so it's a high prepayment penalty. Prior
to that timing, right? So when does that what she means by prepayment, just so you understand this, is do you know when that prepayment runs out?
I actually have that up. Let me look at it.
So what she's referencing is the option on this property, and this is where kind of creative financing comes in, is you have two options. You either, one, you get a new loan, or two, you use, you can assume the existing debt. New loan or assume? New loan or assume? Let me stop sharing so you can actually see this on screen here. So that way you guys can all see this. Okay. So you either put a new loan on it or you assume the existing debt. Okay. So in commercial real estate, you have that option. Most commercial loans are assumable. Not all, but some. So depending on what the terms are of that existing loan, it may make sense to take that on and not get a new loan. And that's what they're trying to determine right now. Is that correct?
Correct. And it matures on March 2028.
Okay.
And it's full term for the prepayment.
Okay. So, and what is the prepay?
I think 220,000 or around that.
Do you know what that is as a percentage?
Oh,
Probably like, that sounds like 1%? No.
2%.
2%.
Like,
Because the existing debt's 2.6 million.
mhm.
So 220,000 over 2.6 million, whatever that math is. So what she's mentioning there is if you pay off this loan prior to that date, you pay a 2% fee on the loan amount. So the loan amount is 2.6 million currently. So they would pay 2% fee on that. So it's actually, that sounds
No, it's
pretty.
1%. Yeah, I'm sorry. I just found it.
1%.
It's 1%.
200 and something thousand, that should be 1%.
Correct.
Right? Okay. Well, that doesn't, I mean, that's not that bad of a prepay. I mean, I understand dollar figure wise, but that's not that bad of a prepay. But in any case, prior to that, you pay that fee. So then you guys are, and then I saw, so she also submitted the deal to Scott, one of the lenders in the back end of your guys' portal with Walker Dunlap. And he's giving you some basic terms. Do you know what those were?
Yes, he mentioned.
It was 6.25%,
Yep,
right?
5-year fix.
And be able to get you about what, 2 point something million, I think? 2.3 million.
2.3, correct. But we just sent him the updated, Cash City sent him the updated rent roll and T12. So he said he'll give us a soft quote by tomorrow.
Okay.
But this was high level from him.
Yeah, great. So what Scott, the lender, is basically saying is, hey guys, I've looked at it and I can probably get you a new loan right around that interest rate fixed for 5 years. And this would be your loan amount. On a $3 million property, I can get you 2.3 million. So what is that on a percentage basis? About 76%. Right?
Mm-hmm.
Pretty good. Whoops. About a 76% loan to value, 76% loan to value, which is really good in this environment. If he can get you that. So that's cool that's the case. And that's on fixed rate, stabilized asset. That's why you're getting that. And that's pretty decent little terms if it makes sense to do that. You have to come up with a little more equity, correct? And it would be full term, I mean, a full amortization, meaning principal and interest payments, correct?
Yes.
Okay. So what she means by that is right now, the assumable loan is what they call interest only. Interest only. So you're not paying a principal payment, so the payment's lower, which increases cash flow on the property. And it's interest only until the maturity date. Is that what I understand?
Yes.
Okay. So there's benefits to that. And then this one would be 5 years. So let's call this you have 4 years left on this and you have 5 years here. I mean, this seems like, and this is at 2.6 million, right?
Correct.
Right. So the assumable is probably the better option.
Okay.
Is that what I mean, that's kind of what I'm seeing. Yeah, it's kind of what I'm seeing. Because I mean, if you can get 2.6 million here and it's interest only up until that date, which is 4 years, give or take, ish, or 2.3 million, higher interest rate, and it's full principal and interest payments, this payment's going to be much higher than this one. So the cash flow is going to be much better in this option. And you have a decent amount of time for interest rates to change and things to improve out till 2028. I mean, you know, you have to take some calculated risks, but if I'm a betting person, if interest rates don't go down by then, the world's coming to an end. I mean, let's be straight up, because it can't go the other way. That I can assure you. And if interest rates don't if you don't have an adjustment in the economy and things happen where interest rates go down by then, we're going to have much bigger problems for you to worry about than this property.
Fair enough. And Shane just
We're
said
all
that.
going to go to Mexico and drink tequila. I can tell you that.
There you go.
Yeah. So it's just, you have to understand, okay, calculating some risks. Sometimes you got to, it's okay, where are we at? What's the likelihood? So things like that when you're making assessments on deals like this. So, any questions in the chat if you want to chat in, and then I'll try and answer those specific to this deal. But so you guys are trying to determine, and I'll throw up the financials. But let me kind of show you the property real quick.
Shane mentioned that our IRR will drop to 9% if we go with the new loan. Right now, I think it's 14% if we assume it.
Yeah, and I saw that. And that's, you're right in that target zone. Because remember, as we've talked, you know, these deals, when you're looking at them and you're analyzing them, you know, you're going to back into metrics that are going to be somewhere in this range. Cash on cash. So 14 to 20% annual rate of return. That's what IRR stands for, internal rate of return. And 6 to 10% cash on cash. So those two numbers are in alignment. I looked at your financials, and we'll pull them up and kind of show everybody here in just a minute. But based on the purchase price and what you guys are doing, it does fit these metrics. And what's cool about it is you're getting a turnkey asset that's been renovated, that is producing and is stabilized in the Phoenix area. Is that what I understand?
Correct.
Okay. And you're looking at their letter of intent. So this is a template that we provide you in the back end of your system that's there that you can utilize, and then you can send it to us. We will help you review those things until you kind of get comfortable using them. But this is how they submitted it. So you'll see the language there. This is a non-binding, non-legally binding letter of intent. It's basically your offer to the broker and to the seller. Hey, if we buy it, these are kind of the terms. So property address, purchase price, deposit, the financing. So they're saying, hey, we're going to assume the existing loan. Then you have a down payment there. They're assessing that at $319,000 because of all they're doing is they're saying, okay, we're buying it for $3 million and the existing loan is 2.6, right? We have a gap there. So that's what we're doing. Due diligence period, they're saying 30 days due diligence, all of which their deposit monies would be refundable during that time frame. They're doing a deposit of $50K. Good deposit there. It's about what, 1.5%, I'm guessing. Okay. And then total closing time, 60-day close of escrow with an option for a 30-day extension. Perfect. So with an additional deposit that goes in to get that extension. So you have 90 days to close the deal. I mean, that's plenty of time in this environment.
How would you determine the additional deposit amount? So we just assumed 10,000, but how would you normally gauge that? Is it a percentage of anything?
Not necessarily a percentage. You know, you may want to, if that's a sticking point, that's the least of your concerns. So it's really going to come down to the price, first and foremost, timing of certain terms of closing and stuff, but you're all within reason and range. So it comes down to a little bit of that relationship with the broker and talking to them a bit. So that way they're comfortable with you and you guys and your little team in what you're doing. So it's going to be that. And if you're assuming the loan, that's great. So they can kind of move through that scenario on the financing. And then I'm guessing that these sellers are in a stressed position, correct?
Yes, very stressed.
Which is why, because they bought the property for nearly 3.5 million, 3.4 and change. And they're selling it, they're going to lose 400, 500 grand, correct?
Correct.
At least, because then you have closing costs and other things in there. So, but what they're doing is getting out of the debt and getting out of the property and going on to fight for another day. And it's mainly because of when they purchased the property. They bought the property in May of 2021, and you're seeing these kind of, this is I call it a stress, non-stress property, meaning they're not delinquent on the loan yet. So they're realizing, great, well, we have a couple options. We're running tight on cash. We're going to be delinquent if we don't handle something. So let's go ahead and sell the property, get away from it, pay off the lender, and kind of lick our wounds. And let's realize we just got caught in a bad yield curve. Yield curve meaning bad timing of the market. Interest rates going up, values going down, and that's what's happening. And you're going to see that this year and next year. So now's the time. Now's the time to go buy. So I love that. Couple of questions in the chat. Cassidy, okay. Do you improve the offer? I see that. 1 second. 32% expenses. It may not seem low in Phoenix. I saw that question in there. So Shane had asked, and I'm going to pull up the financials here in a minute. Shane had asked, does a 32% expense ratio on the expenses of the property seem low? If you were in other markets, yes. But because you're in Arizona and your property taxes are super low and your insurance is super low in comparison to the total expenses, that's why your expense ratio is that low. Those two line items are drastically less in Arizona than they are in most other states. So that's why that number is lower. If that number were traditional in property taxes and insurance were, I guess, normal, like you see around the country, then that would probably be closer to a 45% expense ratio, maybe even 50. But, well, 2004 built, so yeah, you're probably mid-40s. Mid-40s. Let me go ahead and stop this. I'm going to go ahead and bring up the financials real quick. Well, we're going to walk. Actually, I'm going to bring up the property. Let me just go through the OM real quick so everybody can kind of see the property here. So 16 units, it's been renovated, built in 2004, so newer build. Newer construction, which is great because your CapEx, your repairs and maintenance numbers are going to be less. All that's going to be less. So that's kind of a cool little thing. You have a townhome style. I love that it's close to the Grand Canyon University, so you are going to get some transient, but the college kids will love this stuff, I'm guessing. And they can pile up because you have 2 and 3 bedroom townhomes. So what do you think college kids love to do? Pile up. So you'll rent those things like white on rice. So I love that because the college kids will say, hey, 3 friends, let's go get a townhome. So you'll get, and it'll be transient. But the cool thing too is if the kids can't afford it, their parents will. So their parents will co-sign and guarantor the leases. So that's kind of why you're going to get a cool mix of tenant base. So they went in at 4 million and they may sell it for 3 to 3.1. I'm guessing it's going to be somewhere in there. But yeah, all brand new. It's cool. But this is the OM, the offering memo from the broker that's kind of giving you some marketing info, what's going on, its location, all of that about the property. And this is what you get very early on so you can do your underwriting, okay? So just so everybody's looking at this, it kind of gives info and details and photos, and it's a nice little marketing package that the brokers put together for you on these types of deals. And the more and more you see of them, the more and more comfortable you get. So there's your aerial. Is that, I'm guessing you got downtown and then you got Tempe. Is that right?
Mm-hmm. Correct.
Okay. Yeah, so cool little shot. How's the neighborhood?
It's walkable. It was interesting when I was touring the place. 2 ladies came up to the fence and asked if any of them were vacant so that they could lease. And there was other ladies sitting outside the porch. So very family.
Okay.
It seems like, but
does it have entry gates for the drive?
It does. It does have entry gates.
That's nice.
With the call.
It's a cool feature to have. Not all properties have that. So that's actually really cool for just added security. It looks like you backed up to some commercial, which is fine. How's this side of it? Like, is it kind of single family zoning around there at all, or a mix, or what?
It's a lot of mix, but there are a lot of, what do you call it? Apartment units there, like 1-story apartment units.
Okay.
Like it's very common for this neighborhood. So ours would stand out being a 3-bedroom, 2-bath as a townhome.
Yeah. I mean, in the year built's great because it's going to really help you on capital improvements and repairs and maintenance and all that stuff, which you'll be able to drop those numbers a lot more than if you were buying, say, a 1960, 70 product. So that's good. Cool. All right. So let me go ahead and pop up some of the financials real quick. We'll look at those. And they use, so they have another kind of template they use that they felt more comfortable with. So when you're looking at these numbers, this is not the template that's in your portal, but it's one that they like to use for themselves. But anyhow, it's a cool little one. But I'll focus on a couple things here and walk through a couple of the numbers. But let me pull up the chat and answer a couple questions. Let me go through this. Okay, cool. So yeah, you definitely, your IRR, I'm looking at the question from Cassidy. No, yeah, your creative financing's fine. You're assuming a loan. So that's a big portion of it. The rest of it's just equity into the deal. So that can come from several sources, as you all know. That can be, I mean, obviously in this case, the sellers aren't going to finance it because they're stressed, but that can come from other friends and families, people. But if you're producing a return that's in this range and it's a nice quality asset, which it looks like it is, I mean, attracting that money is just putting a nice pitch deck together and getting it out to as many people as you know or don't even know. You know, that's the whole point behind it. Because if you're saying, hey, I'm going to, you know, return you somewhere in that kind of teens number of an annual return on your money, and your money's going into a nice stabilized cash flowing asset, I mean, they have to think in their mind, where else am I going to put that money? I can't get that in the stock market right now. That's probably around 8 to 9% a year. I certainly can't get it in CDs or bonds. I can go risky and put it into crypto and other investments, but that's risk adjusted. So where can I put it into a stabilized asset in a high growth market? And the greatest part about it is you're doing exactly what you should be doing. They bought a property. Now, they tried to sell it for 3.8, 4 million, all this other stuff. And if they were trying to sell a property they purchased in 2021, which I know was the peak of the market, and they're trying to get you more money now in 2024, they're smoking some good juju. Never going to happen because the numbers aren't going to back it up. But you're now buying it for substantially less, almost $500,000 less than they bought it for 3 years ago. 3 years ago. That's great. So now you're establishing a new basis on the property at a new price point to allow that growth to happen over the next several years. And this is what's going to happen. This is why it's so beautiful. You're going to get through this year. You're going to get through next year. By 2026, watch. The rents on this property are going to go through the roof, which is why you want to lock it in now, because you'll ride that up. You just need to get through the next 18 months into 2026, where you're going to start to see rent growth in a lot of these growth markets like this again. Right now, it's flat and if not declining, but it is going to go up. So it's just a matter of time. So that answers that question. So you can get the funding. So you're kind of in this stage we talked about. So yes, to answer your question, kind of where you're at in your best and final, I would start prepping my pitch deck so that way it can be ready for if you get the deal. You don't need to do any more than that at this point. So once you actually get the LOI, and let's say you win the deal, right? You find out you win the deal this week, and now you're going to go into contract. Well, that contract's going to take you about a week or so, maybe even up to 2 weeks to execute, because you're going to get it, you're going to review it. It's going to be some back and forth, negotiating some of the terms before you actually execute the contract in open escrow. So you probably won't be opening escrow until at least somewhere between July 10th and July 14th. Okay, at this point, that'd probably be the earliest. And don't let the brokers push you faster. You don't need to. It's pretty reasonable for it to take that time. Okay, but during that kind of buffer time, yeah, pitch deck's out, you're getting it ready, you're sending it out to some friends and family and other people. Any of that kind of legal logistical stuff that's happening from syndicating is happening in that window. And then keep in mind, you still have 90 days and you still have at least 30 days of due diligence period, all of which you're raising money, you're doing your inspections, you're going through all the processes, everything that you need to do in that closing of escrow, of which we help walk you through. That's why you're here, to get your hand held as you're going through all of that stuff. Okay. Any questions on that, Kiana or anybody else?
No, that was very helpful with
Okay.
the what happens after. So
Yeah, so
thank
kind of just setting up your timelines for where you guys are at. So now you just need to submit your best and final and then build a good little juju with the broker. Because that's really what it is. They just need to, hey, here's your best and final. Ask them. Don't be afraid. So you don't have to play secret about it. I mean, talk to the brokers and say, hey, man, here's kind of where we're seeing it. What other offers are on the table? I always ask that. Sometimes they'll tell you, sometimes they won't. They'll see where it's trading. Keep in mind, the broker's job is to get still the highest price. So it's just a matter of, look, you know where your threshold's at, and you got to hold to it and be true in your numbers and just express that to the broker and say, listen, I would love if they say we see it trading around 3.2. We'll say, look, if the other investors are looking at what we're looking at and they're taking on, and are they assuming the debt? Yeah, they're all assuming the debt. Great. Okay. So then they're looking at similar numbers. They're looking at similar numbers because if they're assuming the exact same debt and bringing in that exact same equity, then you guys are literally looking at the exact same deal because they're not getting better debt than you, right? In terms of the loan. I mean, unless they are trying to project different rental numbers, but once again, you got to be tactful. I think you're going to have flat rents in the Phoenix market between now and the end of 2025. I don't think you're going to get a lot of rent growth. If anything, it's going to go down for a little bit, potentially. But I don't see a lot of growth rental-wise until you get into 2026. But it's a great time to purchase it because you're getting it at a basis, a new price point that's less than they bought it 3 years ago. And that's what you want because you're resetting the property at a price point that is almost $500,000 less than they bought it for at the peak of the market. At the peak of the market. Does that make sense?
Yeah, it does.
Yeah. And you're going to get better debt. So what's going to happen is you're going to buy this baby, right? You're going to get to 2028 or sooner. 1% is not bad. And you may refinance that thing and maybe your interest rate drops into the 5s. So do you know what's the interest rate now?
6.63.
What's that?
6.63.
Yeah. So they're at 6.6% interest rate on their loan now. Okay. So I guarantee, I mean, I should be careful with that. I 99% guarantee that that'll be half of that by then. Yeah, I mean, if it's not, we're in trouble. Like I said, you're gonna have bigger problems to worry about than this. But either way, I'd be darn near shocked if this wasn't 5.5% by then. Or better. Or better. So it's a matter of getting it in, new basis, set it, ride it, cash flow it while you're doing it, and then you get ready for that ride that's going to happen. It's going to happen. Gotcha. Okay. I agree. Yeah, demand starts to outpace in 2026. You're dead on with that. Anybody else in here that wanted to kind of chime in? Let me stop sharing here. So that way, if you have any specific questions from anybody else in here on this deal in particular. So let me show you their numbers here. So if you're looking at this, you may have to zoom in on your screen. So up top, there's an asking price. Then you have their purchase price, right? So they're going in at $3 million. Number of units. They have some acquisition costs and stuff in here. So you got some repairs they're putting in, some operating reserves, perfect. Down payment amount. Then you have the interest only period, which is another 4 years. And then you got some other income and stuff in here. So I'm just looking at this kind of offer column here. So that's good. And then you're taking out all your expenses. So do you see in here how your, and I think you'll get a better management fee. You should play with that, but 8% is fine, but I think you get it down to 6.
We talked to one of the property managers and they sent us an agreement and their fee was 4% plus some nuances for other things, but for their management fee was 4%.
Yeah. So what this will be a great case study too. So let's presume you guys get the deal, and then you get into the escrow, you're going to want to talk about the property manager who's going to take it on. So bring up their fee structure when you get it. At that point, you don't have to do it right now, but when we get to that point, because that'll be a great conversation tool for everybody. And I'll walk through and pinpoint things to look for and not look for in their property management proposal to you. And this will apply across the board to everybody watching that's here, because whether I don't care if it's Phoenix, Texas, East Coast, Florida, Carolinas, anywhere, I'll pinpoint things to look for and not look for in how property management companies add in all these other little fee things into their agreements that I want you to look out for. So that way they'll put in a small percentage number, but then start baking in a bunch of other fees that they charge for. So that's the key component, is not getting ripped off on the repairs and maintenance stuff and how they charge for other things and lease up fees and all these other things we want to look at very, very closely in their proposals to you. Okay. But that's when we get there. So yeah, you're at 32%, but the reason why that number is so low is because of this number here, property taxes. I mean, guys, if that was California, I mean, even at a 1.25% rate in California, that's $33,000. That's 3 times what you're paying here. If that were in Texas, this thing would be like $57,000 a year in property taxes. So that's why your expense ratios are so low. And then your insurance number right here is $7,200. What is that per unit? Can anybody tell me what that is per unit? 16 units? Is that like 5? Is that
450.
5? What's that?
450.
Okay. So to give you perspective, okay, it's 450 a unit, which is probably in line. If you were in anywhere in Texas, just to give you perspective, if you were Florida, that'd be $2,500 to $3,000 a unit.
Holy smokes.
Holy shit. Yeah, I know. I heard. If you were in Texas, it's going to be somewhere around $750 to $1,500. And that goes for really anywhere in the Midwest where you have weather issues. Possible tornadoes, hail, wind, snow, Armageddon, you know, all that stuff. So anywhere in that kind of Midwest corridor, you're going to be somewhere in there. So because you're in, and I'd say this, so Phoenix, or I'll call it Arizona, right? Arizona and Nevada are going to have the lowest insurance and property taxes, which make them very attractive states to invest in. That's why you've had so much growth. That's why, I mean, think about it. That's why Nevada, Las Vegas, is one of the top growth cities in the United States of America. Like, exponential. Why? Low property taxes, no income tax, low cost of living. All those things are happening in those states. So there's massive economic growth, lots of population growth, massive job growth. Everybody wants to be there. Take Phoenix. It's the 3rd or 4th largest city in the United States, if I'm not mistaken. There's a reason why, right? You have low income tax, or I don't think is there any income tax in Arizona?
Nope, no income tax.
No income tax, property taxes are low, cost of living is low, reasonably speaking, and lots of job growth. A lot of companies have come in there, established, and then boom. So you have populations are attracted by the jobs, and away it goes. And that's why you got just exponential growth. Now, with that, unfortunately, now you're seeing a change in the market, which is fine, but the jobs and companies are still there. So it's just literally getting through this window of time of 2026 and 2024, 2025, and getting into the latter part of 2025 and 26. 2026, boom, it's going right back up. So just, you got to hold on and get through that.
Would you add New Mexico into that Arizona and Nevada category for insurance costs?
Yes, probably. Yeah, there's a lot of new growth going into New Mexico. So Albuquerque and some other markets that you got to start paying attention to, because there's a lot of growth going in there. Probably want to double check that. But yes, I'm pretty sure the insurance, I'd have to double check property taxes in New Mexico.
Property taxes are pretty high. It's pretty similar to, I think, Texas.
Yeah, you want to double check that. And then it's really just tracking population growth and job growth. You know, where are the companies? Because what happened is the companies will go in, right? They'll establish their companies, and then they'll draw the populations with the jobs. And so that's going to be your main factors in those markets. But that's why this 32 number that everybody's looking at here, if I can, I'll try and zoom in on that. Okay, for everybody. So this expense ratio number. So in most cases on assets that maybe you may be looking at, it would range, if you're buying a 1960 to 1980 product, it's probably going to be normally somewhere between 45 to 55% expense ratio for that age of product in any markets, but the price gets offset. And then if you get into newer product, that expense ratio is going to be lower because there's not as many repairs and maintenance or capital improvement items. And then to add to it further, if you get into markets like Arizona and Nevada, where your property taxes are low and your insurance costs are low, that's huge line items. Those two line items are huge on your expense numbers. Okay. They're huge. And in this case, they're small. And that's what you want. Gas and electric. Okay. Is the gas, is that just electric or gas? Or is that water on the utilities? It's got to be water and sewer. No, that's a different number. That's down here. Yeah, it must be. You guys must have put it up here, I'm guessing.
I'm going to defer that to Shane, our numbers guy, but I'm assuming so if that's what it is.
Yeah, they put all the utilities in one line item. That makes sense. So, okay, good. So yeah, you just want to double check those, which you will, but they gave you those numbers. So you can take them for what they are, and then you'll do your due diligence if you get into escrow on that. So yeah, scrolling down further, interest rates. I love it. So you're getting to this number, this net operating income number. Okay. So to kind of show everybody is you have your expenses that are right here. So they're taking your effective gross income, that 340, deducting out your expenses to get you the net operating income. Get you the net operating income. And then you got to pay your debt service, which is this. That's your annual debt service. So you take 229 minus 177 is getting you this free cash flow on that property, correct? So that is great. About 4,400 a month. And that'll only get better as that interest rate drops on the loan, because I'm almost certain that if you go refinance that thing in a few years, you'll be able to get new loan on it. Let's call it a 5-year loan or even a 7-year loan, however you guys do it, where your first year, or maybe 2 years, but at least first year will be interest only again. And it'll be interest only at a new interest rate. So you'll be able to come in there and probably get, 5.5% interest rate. And it'll be interest only during that time period. So that's going to boost up your cash flow again. And the value of the property is going to go up. So this is how beautiful this is going to work. Because that property will probably go, let's say you buy it 3 million or 3.1, whatever the number ends up being. And that thing is worth 3.5, 3.6 in a few years. Okay. Because interest rates drop, cap rates compress, value goes up. And now all of a sudden that thing goes to 3.5, 3.6, 3.7. You do a cash out refinance, you increase the loan. Because now let's say you go from you're at 3.6 hypothetically. Then you go back to Scott at Walker Dunlap or any of those other lenders in the system, and you go ahead and get a $2.8 million loan. Okay. And you take out the 2.6 that's there. And now you have 200 grand in free cash flow just coming back out. You're going to pay some of your investors back or off, depending. And then you have some free cash that's tax-free that you can go do other things with. Does that make sense?
Yes, it does.
Yeah. And that's how the game is played. So typically you'll refinance properties normally every 5 years, sometimes 3, depending on the market. So, but typically every 4 or 5. So right around that time is going to be really good timing on that.
Mhm.
Gonna be good timing. So that is the financial side of it.
If you go to the summary tab, it shows us the IRR, the
Sure.
cash.
So I'm going to zoom in on this for everybody. So this is kind of the summary tab. What they're saying is, hey, the investors were asking for, they're going to hopefully buy it for 3. That's about $187,000 a unit. They're putting this earnest money down. It's that down payment. These are all the things that we've talked about and shown you. And they're going to assume the existing debt on the property at 2.6. That's the interest rate. They still have 48 months left of interest only on it. Then they have some closing costs they're building into that. Then they're putting in an acquisition fee. Remember, we talked about acquisition fees, 2 to 3%. They're using 2. So how much money are you guys bringing into this?
We were looking to do 200K, but that would be very helpful to talk through.
For you guys?
Mhm.
Do you guys need to bring that in?
Well, that's what I was hoping that we could talk to you about. Like, how do we put the minimum amount of money into this?
So in this scenario, I mean, quite honestly, so based on the equity amount of 330,000,
Mhm.
okay, what's the total equity if you include closing costs and everything? Is it 557? Okay, beautiful. So 557,000 would be the total equity required for the deal. That includes closing costs, all your fees, everything. So typically, based on a syndicated structure, you would bring in 10% of that. Typically. So if your equity requirement is 557,000, I'm going to stop sharing this for a minute so everybody can see the screen. Does everybody see me okay on the screen? So I'll walk through this.
Mhm.
Okay. Awesome. So 557,000, we'll just use that for simple math. So the general partner, which is you guys, typically call it $56,000. That'd be 10%. And then the LPs would bring in the difference, which would be about 500 grand, right? Hypothetically, just for a minute. Now, you can, and then that structure, you would typically go with a 70-30 split, meaning 30% to you, to the LPs. That's typically how that would be done. Okay. Now, if you bring in more than that, then you're going to be getting more of this. Does that make sense?
Correct. And
So
so,
what I would say is if you guys are going to bring in 100 grand, because I would probably stick around there. If you guys have the ability to bring in 100,000 of your own money, then you bring in 100 grand. That's 25%, give or take, of the total equity required. Give or take, pretty close. Or 20%. 20% of the total equity required. So I would be switching this baby to a 60-40. Potentially. Okay, potentially. But once again, when you do that, take a look at the returns that are projected for your investors and kind of back into a number that, okay, I mean, because most people right now, if they can get anywhere between 12, 13, 14, 15, 16% annual return on their money, they'll move money into an asset like that that's protected. It's a 16-unit, newer construction, Phoenix, Arizona, cash flowing asset that's stabilized. I mean, if you came to me and said, hey, do you have an extra 50K? Yeah, I do. What are you doing with it? Well, it's sitting in my bank. Crap. So it's going down. Great. Well, I have this to look at. I mean, if you're not putting it anywhere else, why don't you take a look at this? Or who do you know that would be interested in this? Because that type of return, they're not getting it in the stock market, right? I mean, they're probably getting 8 to 9% a year in the stock market. If you look at it, if you annualize stock markets, it's 8.2% a year. Just FYI. Like, just so anybody knows, you have ups and downs, up and down, up and down. If you actually annualize the stock market, S&P 500, over a 100-year window, your average is 8.2% a year. Very, very proven. So that's what you're getting in stocks. Okay, great. So we're going to get more than stocks, and we're protected in real estate. We get tax advantages. We get cash flow. We get appreciation benefits. We get to hedge against inflation, and all these things get to happen by being an investor in your deal. So where else am I going to put that money? So that's why anything in that kind of lower teens, middle teens on an annual return right now that's protected, people will be interested in that. And that's how you'll attract the money. Does that make sense?
Yes, that makes a lot of sense. And I
Yeah.
think,
And it will drop the IRR. So I saw that come in from Shane. Yes, it will drop your IRR. But so you can fool around with it. You can give away as little or as much as you want. Obviously, at the end of the day, when I say this kind of 14 to 20%, call that a property level. But if you came in here and you're able to give somebody a 12% to 15% on their money for an investor, that's going to be attractive, because that does not include the tax benefits. Because you're going to add that in to do an accelerated depreciation, especially if you guys are planning to hold this for a while, which I think you are, correct?
correct.
Yeah. So if you're holding it for a little bit of time, then doing the cost segregation and accelerating the depreciation, so all of that bonus depreciation comes back to you and the investors, is the way to do it. Because then it's going to take this and probably bump it up when they're looking at their tax scenario, probably 20+% a year on a return. Because if I don't have to pay Uncle Sam and I get a tax benefit all day long, because my return's actually much higher than that. Does that make sense?
Makes it absolutely. Thank you. No, that's really helpful, because we
So that's kind of the way to look at it. But it's, run your numbers, but you're either playing at 70-30, but point being is you don't have to bring in more than 10%. So technically, I would not bring in more than $56,000 and try and raise the difference. That's what I would do. You can always bring in more. And when you do that, you can start to adjust the splits and returns. But I would start with going into the deal with 57,000, 56,000 from you guys, because that's going to boost your returns and then raise the difference. And if you get to the point, maybe at the end of the deal and you're 50 grand short or 100 grand short, well, then you have a decision to make. Do we bring it in ourselves or do we figure it out another method? Does that make sense?
Yeah. Do we ask you for your fund? I'm just kidding.
It's probably too small of a deal, but
Yeah.
I mean, it's in the market. I mean, it's definitely in the market. But once we get there, I mean, I would say this. I mean, yeah, if it were a little larger deal, we'd definitely consider it in Phoenix. But it's probably just a little bit too small for what we probably approve. But the property's great. I mean, it's in a good market, good location. Definitely like it. It's just probably from that return standpoint in the price, not price, but the unit count is a little bit too low. But yeah, I like it. I mean, I think it's a good deal. I don't think you're going to have a problem raising that money. I just don't. Not on this quality of an asset. It's just a matter of setting up your pitch deck and getting it out and showcasing it to people in your database, and you'll be surprised. You'll be surprised, especially if you start pushing the tax benefit side to showcase what people are going to benefit from. Because in most cases, when you do this, you're probably going to find out they're going to get about 86% to 95% on their money year one in a tax benefit. What do I mean by that? If someone gives you 100 grand, when you do your cost segregation study, which is probably going to run you about $6,000 on this property, give or take, maybe a little bit less. Someone that gives you 100 grand, if they invest this and you do your cost study, I'm going to guess they're probably going to get somewhere between 80,000 to 95,000 in a K1 statement for 2024.
Okay.
I mean, it's powerful, especially when you have somebody that's going, excuse my language, holy shit. Because this is what's going to happen. And this is why you'll be perfect timing, because you're going to have, call it July, August, September. Beautiful. So you say to all your folks you're talking about, hey, have you talked to your CPA yet? Do you know what your potential tax burden is for 2024? Have you tax planned at all? It's going to raise a question in their mind. They're going to say, well, I'm going to probably have to pay IRS, and this is probably 80 grand or whatever their number is. Okay? I'm going to have to pay Uncle Sam and the government 80 grand this year based on my projections on my income. Really? Would you like to wipe that out? And earn 12 to 15% a year on your money. Okay, would you like to get a chance to wipe that out? Because we can probably give you this based on our projections about $80,000 to $90,000 in a negative K1 to go against capital gains taxes and potentially income taxes, like personal income taxes, depending on your tax status. It's a very powerful tool, which is why as you get to the latter part of third and fourth quarter of every year, everybody's looking for, gosh, you have to think for a minute. It's either Uncle Sam or real estate.
So does the K1 offset the W-2 income then, if I heard that?
It
On the
depends.
status.
It depends. If they are, two ways they can do this. They either have a spouse, if they jointly file, they have a spouse that's a real estate professional, has a real estate agent license, or a real estate professional spouse. So they joint file. Answer is yes, because they're joint filing, so that W-2 is going to get the benefit of their spouse. If they are not joint filing, they're filing single filing, then they need to be classified as a real estate professional in addition to their W-2. So let's take a doctor, for example. A doctor invests with you and they're obviously a doctor. Well, they're going to need to showcase that they're a real estate professional as well, which is a certain number of hours spent in real estate to get that tax advantage to then write off W-2 doctor income and capital gains income. Does that make sense?
Yep, that makes a lot of sense.
That's, for full disclosure, talk to a CPA.
Yes, of course.
Yeah.
We can stick to our initial letter of intent then. We don't need to make any adjustments or increase the price or anything. We just hold.
Well, yeah, I would talk to the broker on where you're at. So you have this thing finalized. I'd get on the phone with the broker before the timing today and say, hey, this is kind of where we're planning on coming in. We listen, we like the asset. We want to get it done. Where are you seeing things trend? How can we make this happen? And just be straight up with the broker in those discussions and have that call. And find out how many other offers are on the table right now. We're having to stick to our numbers based on this. What we're seeing is this. In order for us to bring in our money and attract our other investors who we have lined up, we have to give them some decent return. And so we're seeing it cap out based on our numbers here. We would love to pay more, but it only produces so much income.
Yeah, the numbers talk. Okay.
So unless other investors who are putting in offers are over projecting their rents or something, keep in mind, it's only as good as the paper that it's on. So yeah, it's very important. Well, I think this is super helpful. Does anybody have, so Roger had asked a question about the depreciation. Is it useful? No, the depreciation is useful for years 1 through 5. So typically, just so you know, on the bonus depreciation, accelerating depreciation, when you do this, you're getting the benefits years 1 through 5, typically. Your biggest year, though, is year 1. You get the biggest chunk year 1, and then you have other years behind that. So just FYI. But that's, you can do a little research on that in the bonus. There's plenty of videos on it on YouTube and other things. But bonus depreciation and what's going on with that are really valuable tools in real estate. In addition to the cash flow, the appreciation, inflation hedge, all the other stuff you're doing, the tax side, it's not what you make, it's what you keep, right? What you keep. And so tax, planning and legal tax avoidance is the way to go. And that's why people invest in real estate. It's not just for the cash flow, and it's not just for appreciation. It's for all these other benefits, taxes being huge on them. So, awesome. I know we're coming up on the edge of time, but let me, there we go. Sorry, I kicked you out, Kiana. But I hope this was helpful on this property and kind of showcasing this asset and what they're doing. And let us know how it goes. But yeah, get on the phone with the brokers as you're finally submitting your LOI. Get a feel for the other offers. How many are there, where it's at, and what you guys can do. Because I think it's a nice property in a good location. You're in the heart of Phoenix. And it's worth going after. Absolutely worth going after. I think you guys are doing a great job. So fingers crossed on it. But yeah, stick to your numbers. If you need to, what does 3.1 look like? I would look at that. What is 3.1? What is 3,050,000? Where's there an edge in there? Is there any room to kind of wiggle it a bit and make a little bit jump projections? Because what I would do is this. On your numbers starting in 2026, I would bump your rents quite a bit. So if you're looking at those numbers for down the road, 2024, 2025 are pretty static and flat. But your 2026 numbers and your rent growth and all that other stuff should be bumped up a decent amount. I don't know if that's 5%, 6% a year, but I'd be pushing them. I'd be pushing them 2026, 2027, 2028 in that pro forma. And that may get you better numbers to allow you to increase the purchase price just a bit. That's a good calculated projected risk. Good calculated projected risk for 2026 and beyond. Okay. So awesome, everybody. I know we're jumping off, but chime in and get back to us if you have any other questions or things you need. So rock and roll. Yeah, play with those numbers.